Good day, everyone. I'm Michael Chang, Chief Investment Officer, Fixed Income at RHB Asset Management. First of all, thank you for listening to this update, and it is my fifth podcast. Second quarter GDP contracted sharply when it was released this month and was down minus 17.1% year on year, far below consensus estimates of minus 10.9%, led by the sharp reversal in private consumption of minus 10.8%. and investment dragged off minus 7.2%. This plunge in GDP number was sharply lower than Q1, we were reading of plus 0.7% year on year. The Q2 GDP plunge was the biggest drop since the Asian financial crisis in year 1998. Prior to this GDP announcement, the overnight policy rate was slashed 25 basis points lower to 1.75% on 7th of July as a preemptive move well before the announcement of the Q2 GDP. Despite the bleak economic outlook, global funds have been pouring into the Malaysia's government bond market. Net foreign inflows totaled US dollars 4 billion in the 3 months through July, coming close to erasing the cumulative outflow of US dollars 4.7 billion in the previous 3 months during the March sell-off globally that was caused by the COVID-19 outbreak. One of the key attractions for overseas investors is Malaysia's relatively high real yields, which are being bumped up by a 5-month bout of deflation, with the latest July consumer price index of minus 1.3%. With this, Malaysia's 10-year government bonds, currently at a nominal yield of 2.5%, translates to a real yield of 3.8%. In addition, the Malaysian bond market has over the years been renowned for its established backstop and market resilience. This test was as recent as this year's March global bond market sell-off. While Q2 GDP has been disappointing, the Malaysian bond market has outperformed. This quarter, the Malaysian government bond market has been a boon to offshore investors, where it has returned more than 5% in US dollar terms, far outpacing their nearest competitors such as the Philippines and South Korea. Malaysia's benchmark 3-year yields have fallen almost 40 basis points over the period after dropping by 75 basis points in the first half of the year. Malaysia stands favorably among emerging market peers as it has seen deflation for the past 5 months. This is also apparent in Thailand. Indonesia's CPI slid to the least in 2 decades in July. The 3 countries mentioned all offer 10-year real yields of above 2%, putting them in the top tier of major emerging markets. In addition to the favorable inflation picture, another factor burnishing the appeal of Southeast Asian bonds from a real yield perspective is the low currency volatility, a key consideration for investors who prefer not to use FX hedges. One exception to the overall picture of benign inflation regionally is the Philippines, where consumer prices unexpectedly climbed 2.7% in July, nearing its 10-year bonds, sinking real yield to almost zero. In another chart comparing currency volatility, only Indonesia's rupiah emerges as the world's top 8 most volatile EM currencies. While South Africa, Brazil and Mexico offer notably higher bond yields, they also come with some of the most volatile currencies globally. When comparing to these currencies, Malaysian ringgit exhibits lower volatility generally. This preference towards emerging market local currency government debt is also consistent with the flows seen coming into the emerging markets as illustrated in the Bloomberg's Emerging Markets Capital Flow Proxy Index, where the index has climbed up to its low of 104.108 in March to 138.179 currently. That said, it is still below the high period of 157.272 back in January 2020. In summary, there's a chance of a 25 basis point cut in the OPR come 10 September 2020 to 1.5% when Bank Negara meets, given the sharp fall in growth rates in Q2, and to minimize the financial impact when the debt moratorium expires on 30th September 2020. positive real yields for Malaysia, low ringgit volatility, a resilient government bond market post the episode in March 2020, and containment of the COVID-19 situation in Malaysia are catalysts that would support the local bond market. While there is a risk of MGS being excluded in the FTSE World Government Bond Index come September 2020, we believe this uncertainty has been somewhat discounted by market given a predominant low yield environment globally. Any knee-jerk sell-off could present an opportunity to accumulate. Thank you for listening to this podcast. We hope this podcast has been useful to you and gained insights to the bond markets.